Hi, welcome to our introductory lecture on accounting and financial statements. Collectively, when we refer to financial reporting, it's the information that a firm provides about its positions, its performance. Collectively, these are known as the financial statements, and those financial statements can be stock statements, statements that are a snapshot at a point of time, or a flow statement that captures information over a period of time, say a month, a quarter, or a year. Now, the International Accounting Standards Committee, the IASC, defines financial reporting as to provide information about the financial position, performance, and cash flows of an enterprise that is useful to a wide range of users. And in my work and through the exam, the financial statements are really a key document that you'll use to evaluate any sort of investment, whether you're a credit investor making a loan to a firm, an equity investor thinking about purchasing the stock or making a direct equity investment in a firm. These financial statements and how good they are, how high quality they are, will be very important to your analysis. Now, accounting can generally be segmented into two types: financial accounting. And financial accounting is what you'd normally encounter when you look at an annual statement, a publicly disseminated report on a company. Its purpose is to prepare financial statements that are going to provide information to outsiders. We'll talk about this a little bit more later, but one purpose of that is to make sure that data is comparable to other firms and across periods. Managerial accounting, on the other hand, is really information used to give or provide to managers within the organization to help run the firm efficiently and effectively. Sometimes these overlap. Sometimes one is the source for another. But a key thing to remember is the managerial accounting generally does not have to comply to accounting standards, be them international or domestic. Now, as I mentioned on the last slide, financial accounting needs to conform to certain standards and principles. Those are generally known as Generally Accepted Accounting Principles, or pronounced GAAP, and they are the standard framework for financial accounting. They can be both domestic, sometimes we might refer to them as US GAAP or UK GAAP if we were in the United Kingdom, or international GAAP, as we mentioned, the International Accounting Standards Boards would set those. Let's begin to talk about some of the primary financial statements. First and foremost is the balance sheet. The balance sheet is a stock statement. It's a statement taken at a point in time, a single point in time. On the balance sheet, on the right-hand side, or the top part, if the balance sheet is organized vertically, is going to be the assets, and then the left-hand side, or the bottom portion, are going to be the liabilities and the owner's equity. We'll get into this a little bit further, but there's also a certain way that every balance sheet is organized. For example, the asset section is organized from the most liquid asset to the least liquid asset. And the second major financial statement is known as the income statement. It's a flow statement. It captures data over a period of time, perhaps a quarter, a month, or a year. It's going to provide information about the performance of the firm, what it earned, what it spent over that period of time. A third financial statement, very important, the statement of cash flows. It again is a flow statement that captures cash receipts and cash outflows. And then these items are then classified. Were these cash outflows operating, investment, or financing activities? The cash flow statement can be put together two different ways. A direct method, which actually captures the direct cash inflows and cash outflows of the firm, or what's known as the indirect method, where you begin with the net income of the firm and they make adjustments to that net income figure to arrive at a cash flow. One notable and usually the most significant adjustment to that net income is an adjustment for depreciation. As you might recall, depreciation is not a cash outflow. So that's an example of how the indirect method might be used to adjust net income. The fourth financial statement is known as the Statement of Owner's Equity. It can also be called the Statement of Changes in Earned Surplus or the Retained Earnings Statement. And it reports amounts and sources of changes in equity from transactions with owners. Now, many times today, you won't find this as a separate statement. It'll be incorporated into the balance sheet or combined in an income or returned earnings statement. For almost all public companies and for many private companies that prepare financial statements for wider distribution, there will be a statement called Management Discussion and Analysis. A short form might be called MD&A. And it discusses results of operation, resources, liquidity, has a number of disclosures about contractual obligations, contingent liabilities, and things like that. And they may or may not have some forward-looking statements in the MD&A to discuss forward-looking trends. Management discussion and analysis is a very important statement. It's really management's words and can go into much more qualitative detail than just what the numbers, and may provide a story behind the numbers in the other three more quantitative statements. Also incorporated into the financial statements will be the financial notes and supplementary schedules. These are often called the footnotes to the financial statements. These provide other information, legal issues, acquisitions, important customers, may provide some segment data on the firm. In my work and in my past work, I almost always read the footnotes and the MD&A first before I actually began to look at the financial statements, because many times the footnotes and the MD&A will give you clues about what to look for when you're evaluating both the flow statements, such as the cash flow statement or income statement, or the stock statement like the balance sheet. Another item incorporated into financial statements almost exclusively with public companies is the auditor's report, where an independent accounting firm evaluates the statements and professes that they have been prepared in accordance with generally accepted accounting principles. They may issue an unqualified opinion, sometimes known as a clean opinion, or they may issue a qualified opinion, which indicates something is not in accordance with some accounting standards. There could have been a disagreement with management over an estimate. There could have been a disagreement with management over how a particular revenue was recognized, things like that. So there are several different things that can result in an unqualified opinion. It's important to read this statement. Many times people will gloss over it, believing it's just boilerplate, but if there is any sort of anomaly in the statements, it will typically be mentioned in this report.